Hello, I'm David Hardesty. And in this lecture, we begin our discussion of the U.S. taxation of U.S. owned foreign corporations with a look at the general rules. The objectives of this lecture are as follows. First, we want to understand the special considerations for U.S. taxation when a foreign corporation is owned by U.S. taxpayers. We want to also understand the general rules for the U.S. taxation of U.S. owned foreign corporations organized in treaty countries. And we want to understand the general rules for U.S. taxation of U.S. owned foreign corporations organized in non-treaty countries. Let's start with a look at the special considerations for U.S. owned foreign corporations. The general rules for the U.S. taxation of foreign corporations are the same, regardless of whether those corporations are foreign-owned or U.S.-owned. These general rules are those we discussed in the unit on inbound transactions. What makes the U.S. taxation of U.S.-owned foreign corporations different from the taxation of foreign-owned foreign corporations is primarily the potential for involvement of U.S. personnel in the management of the foreign corporation and the increased possibility this creates for the foreign corporation to be taxable in the United States. As we will see, the increased potential for U.S. taxation results where U.S. personnel are involved in the day-to-day operations of the foreign corporation, or the U.S. owner or its personnel act as agents of the foreign corporation. If a foreign corporation is taxable in the United States, then the United States will directly tax that corporation. That is, the United States will force that corporation to file a U.S. tax return or will prepare a return on behalf of the foreign corporation and will impose U.S. tax directly on the corporation. Let's turn to U.S.-owned foreign corporations organized in treaty countries. As we learned in our study of inbound transactions, where a foreign corporation is organized in a country with which the United States has a tax treaty, business profits of that corporation are taxed in the United States only to the extent they are attributable to a permanent establishment in the United States. This basic rule does not change when the foreign corporation is owned by U.S. shareholders. If the foreign corporation has officers or employees located in the United States, and these individuals perform core business activities in a fixed location in the United States, then the foreign corporation may have a permanent establishment at that fixed location, and the profits attributable to that location will be taxed in the United States. For example, assume Foreign Co. has an employee in the United States working out of the offices of Foreign Co.'s corporate parent. Also assume the employee is involved in the day-to-day operations of the foreign corporation, such as approving sales over a certain dollar amount. Where this is the case, there may be a permanent establishment in the United States, and if so, there would have to be an analysis of the profits attributable to that employee's activities. Those attributed profits would be taxed in the United States. A foreign corporation can also be taxable in the United States under a tax treaty if it has a dependent agent in the United States. For example, assume Foreign Co. has no personnel in the United States, but its corporate parent performs certain essential functions for Foreign Co., including making contracts on behalf of Foreign Co. in the United States. And Foreign Co. has the authority to supervise these functions. The U.S. parent may be a dependent agent of Foreign Co., in which case there is a permanent establishment in the United States, and profits attributed to the activities taking place in the United States are taxable in the United States. It is worth emphasizing that in the case of business profits, only profits attributable to the permanent establishment are taxed in the United States. Thus, even if business profits are taxable in the United States, the amount of tax may be limited. In addition, it is worth emphasizing that the preparatory and auxiliary activities performed in the United States do not create a permanent establishment. This significantly raises the threshold for taxability. As we learned in our study of inbound transactions, foreign corporations from non-treaty countries may be taxed in the United States on income that is effectively connected with the conduct of a U.S. trade or business. This is true as well for U.S.-owned foreign corporations. For a company organized in a non-treaty country, the threshold for taxation in the United States is much lower than for a treaty country, and taxability is much less certain. Quite simply, as we've learned, a foreign corporation merely has to be engaged in the conduct of a U.S. trade or business to be taxable in the United States. Physical presence is not required. In addition, a trade or business can exist in the United States if the company has presence in the United States through personnel or agents, regardless of what those individuals are doing. Thus, preparatory and auxiliary activities performed in the United States may create a U.S. trade or business where those same activities may not create a permanent establishment. This means that a company organized in a non-treaty country may be taxable in the United States where the same company organized in a treaty country would not be taxable. If there is a U.S. trade or business, then as we learned in our study of inbound transactions, all U.S. source business income will be connected to that business and taxed in the United States. Taxation is not limited to income attributed to the U.S. trade or business. Let's elaborate a bit on the issues associated with activities in the United States, starting with contracts made in the United States. One way in which a foreign corporation may acquire a U.S. trade or business or a permanent establishment is if contracts it makes are regularly approved by personnel located in the United States. For example, Foreign Co. is a U.S.-owned foreign corporation that sells expensive products. It is organized in a non-treaty country. All of its activities take place offshore. As long as the company's income is not effectively connected with the conduct of a U.S. trade or business, then the United States will not directly tax the profits of Foreign Co. However, as explained in the text at 1303(2)(a), where contracts are regularly negotiated and approved in the United States, the foreign corporation may be deemed to be engaged in the conduct of a U.S. trade or business. So what happens if a foreign corporation's activities take place mostly offshore, but contracts are approved in the United States, causing the company to acquire a U.S. trade or business? Will all of the sales be deemed effectively connected with that U.S. trade or business? Ordinarily, effectively connected income will include only income that has its source in the United States. Foreign corporations run a serious risk if they fail to file U.S. tax returns and are subsequently found to be taxable in the United States on business profits. When a foreign corporation files a U.S. tax return to report business profits taxable in the United States, it calculates taxable income in the same way as a domestic corporation. It pays tax at regular tax rates on net taxable income. However, under IRC Section 882(c)(2), a foreign corporation found to be taxable in the United States, but which has not filed a U.S. tax return, may be subject to tax in the United States on its gross income. Failure to file a U.S. tax return means the corporation may not be able to take deductions against income. Because the failure to file a U.S. tax return imposes some degree of risk, a foreign corporation that may be doing business in the United States should file a U.S. tax return, but claim that no income is effectively connected with the conduct of a U.S. trade or business. This way, if subsequently found to be engaged in the conduct of a U.S. trade or business, it can take deductions against that income. A unique problem exists for digital product sellers that are subject to tax on sales to customers in the United States. This problem has to do with identifying the location of digital product sales. According to the analysis in the text at 11b.045, the location of a digital product sale may be the location where the customer takes delivery of the product, usually the customer's computer, or it may be a location that is determined based on the sales contract. In the text, there is some authority for placing the location of the sale at the location selected by the parties to the sale. This location will often be identified in the sales contract. For example, the contract may say that the location of the sale is the web server from which the digital product is downloaded. However, if the substance of the transaction is not in line with the terms set out in the contract, the terms might be ignored. For example, if the customer is not obligated to pay until it successfully receives the software on its computer, a term that places the sale at the location of the web server might be ignored. If the location of the sale cannot be identified based on the contract, then the location is ordinarily where the benefits and burdens of ownership transfer to the customer. The benefits and burdens may transfer, for example, when the software is successfully recorded on the computer's hard disk. In this case, the location is the seller's computer. On the other hand, the customer may take delivery on the seller's computer, where, for example, the software is held on the seller's computer for a relatively long period to be downloaded at the convenience of the customer. A determination in this case depends on all the terms of the contract and the actions of the party.